Welcome, and a big welcome to Andrew Headley. Thanks very much for joining us in person in South Africa for the first time in a while.
Oh, thank you, Rob.
Andrew Headley is Portfolio Manager and Head of Global at Veritas Asset Management. They are the portfolio managers on our Ned Group Investments Global Equity Fund. I'm going to let Andrew run through a few slides that talk to recent performance, what's been going on in the portfolio, the drivers of that performance, and perhaps some of the positioning, where we're currently sitting and how that might fare into the future. After that, I'm going to come back and grill you with a few questions. So over to you, Andy.
Perfect. Thanks, Rob. Okay, so I'd like to first start with performance. So this slide that you can see shows performance year to date, 1 year, 3 year, 5 year, and since inception. And I just really wanted to talk a little bit about 9-month performance. As you can see there, we're falling with the market, with the fund down 24.5 and the market down around 25.4. So we're slightly ahead of the market, but perhaps not as much ahead as we would generally anticipate in a weak market. And I think there are 3 primary reasons why we're not doing slightly better in what is clearly a difficult market. And so I think it's worth running through those. The first of them is what we don't own. So as high quality investors looking to invest in areas with high returns on capital employed, strong balance sheets, good cash generation, strong competitive advantage, we don't own any positions in energy or in banks or in utilities. And those are the 3 best performing sectors of the market. As you can see here, the energy position here shows minus 1.5 percentage points on the right hand side. That's basically because we hold nothing. So by holding nothing, it's cost us 150 basis points. The same with financials, cost us 60 basis points, and the same with utilities. So those 3 positions together add up to around 2.5% headwind to the fund, which we will never own, positions in banks, energy, and unlikely to own positions in utilities. So that's one of the 3 reasons. The other 2 reasons that we're not perhaps doing a little bit better are shown on this slide. So firstly, healthcare, where we've had mixed performance. Now, generally, healthcare performs very well in declining markets, and we have seen a bit of that year to date. So we have multiple positions in healthcare. Some of them have done extremely well. So the likes of CVS has done very well, which is a retail pharmacy in the US. United Healthcare, which is a health insurer, again in the US. So these have performed really well for us. But at the other hand, we have companies like Catalent and Thermo Fisher, which are very high quality companies with quite high growth rates that haven't performed very well. And we think there's 2 real reasons why they haven't performed well year to date. The first is that they're quite highly rated companies. So despite being very high quality and high growth, their valuations optically were quite high. So they had high PEs and relatively low free cash flow yields. And we were comfortable with those because we're very long-term investors, and over the very long term, we were pretty confident that the growth rate of the company's free cash flows was more than compensated for in those valuations. And so we felt that we'd generate, high double-digit returns in these businesses. But with the increase in inflation and the increase in interest rates that we've seen across the world, what's happened has been that the risk-free rate that investors use to discount valuations has increased. And that's meant that valuations, particularly of long duration assets, so these growth companies where the value is a long way into the future, those assets have fallen the most. And some of these healthcare companies that we own have been subject to those falls. And so we've seen a little derating in some of these companies. So their ratings, their multiples have fallen along with other growth companies and quality companies. And we think that's largely done now. We think the derating of these companies has happened. We don't think they will derate further, particularly from here. And they're all high quality companies that continue to grow. So we're very confident in the growth rates of these companies. And unlike companies that are economically sensitive, so consumer discretionary companies like, let's say, Nike, these healthcare companies that are growing very fast, they're not subject to economic movement. People will still have to take drugs, regardless of what the economy is doing. And so we're very confident in the growth rates of these companies continuing going forwards. And so we think the derating has largely been done. The second issue that's impacted the healthcare companies has really been COVID. Many of our companies, so Catalent, Thermo Fisher would be good examples, Sonic Healthcare in Australia, they've been big beneficiaries of COVID. So Catalent, for example, they make the Moderna vaccine. So they've made hundreds of millions of doses of this vaccine that they've been paid for. Sonic Healthcare does a lot of diagnostic testing. And again, the amount of diagnostic testing has hugely increased as a consequence of COVID. And so these companies have had a revenue benefit in 2020 and 2021 in particular from COVID over those 2 years. And what we did as analysts was we looked at those revenues and the profit that they made from those revenues, and we valued them at 1 times earnings because we feel it's a one-off, it's unlikely to occur again. So we weren't attributing a continual earnings power to the valuation. So what we're seeing in 2022 and probably more in 2023 as well is that the COVID revenues these companies have benefited from are declining. So instead of maybe earning $1 billion in revenues last year, they might be earning 400 or 500 million this year and maybe 100 or 200 million next year. And so they're seeing this decline in revenues from COVID, which makes no difference really to our valuation because we're not really valuing those revenues and earnings. But it does seem to impact other investors' view of these companies because the headline, so that the growth rate of the company as a whole is slowing down as these COVID revenues are coming out. But we look at the underlying growth of these companies. And so if we take a company like Catalent, which is a biological manufacturing business really, their underlying growth rate remains at 20%. So yes, they had this big increase in 2020 and 2021. And obviously at a headline level, their growth is much slower in 2022. But the underlying growth of the business is still 20% in 2022. So we see these companies as really well protected, but they have had this short-term headwind, and we think from here that they will do very well given that they've already derated and their underlying growth rates remain very robust. And then the last impact really in the portfolio has been we've had a couple of very positive positions within the portfolio, so the likes of BAE and CVS, for example. But we've also had a couple of things that have hit us very hard from a negative perspective. The two that I'd draw out, which have been particularly negative, which you can see on this slide as costing us at the top there, minus 1.8% and minus 1.6% respectively, are Charter and Meta, also known as Facebook. So just turning to those two, Charter is one of our bigger positions, again shown here as a negative performance, our biggest negative performance in the portfolio, and Meta the second worst, and then after that, as you can see, the impact is a lot lower. So just turning to Charter and Meta, we think that these businesses remain very competitively advantaged. The impact on Charter that is worrying the market is the impact of what's called 5G fixed wireless access. So Charter makes most of its profitability from selling broadband to US subscribers. So it sells high-speed internet over its existing infrastructure, which is a mixture of coaxial cable and fiber. And it sells that to residential consumers in the US. It's passed around 52 million homes, and they have a penetration rate of just over 50% of those homes with broadband. And it's very well placed because this infrastructure has been in the ground for a long time, and through software, they can increase the speed that goes over that network. So they can get up to, say, a gigabit per second speeds over their current network, and they can increase that to 10 gigabit speeds with more software and what's called high splits, which are relatively low cost. But there's a new competitor, which is called fixed wireless access, which is the mobile telephony companies using spectrum to deliver fast broadband over 5G to residential customers. Now this year, Charter won't show much growth in the number of net new subscribers to broadband. And that's after a couple of years that have been phenomenal with COVID. So again, they're a COVID beneficiary, where their subscribers went from 1 million a year, so their net new adds went from 1 million a year, went up to 2 million per year during COVID. And in 2022, their net new adds are going to be very low, so they'll be somewhere between 0 and maybe 200,000. So they've declined from an average of 1 million, they went up to 2 million, they're going to go down. And part of that is because they pulled forward demand during COVID, so people needed a fast broadband subscription, and they pulled forward that demand. But equally, there is some threat from 5G fixed wireless access, which is this new type of internet connection, but it is slower but it is cheaper. And so there is a cohort of consumers that will use fixed wireless access. We think there are three in that cohort, or three separate cohorts. First is rural consumers who have no other option, so they're likely to subscribe to FWA. Secondly, are businesses that are temporary, so think of building sites, diagnostic testing centres that move around. They would need an internet connection, and so fixed wireless access is a very good solution for them. And thirdly, are residential customers, but those who don't need fast data speeds. Fixed wireless access tends to be about 100 megabits a second, rather than the typically 200 to 400 megabits a second offered by Charter. And also that they're price conscious, because fixed wireless access is priced a little bit lower than fibre and cable broadband. So we are seeing them take some subscribers in 2022. We think they'll take some subscribers in 2023. We think most of those subscribers will come from the rural and the business community that I talked about, but some will come from the type of consumers that might have subscribed to cable. But there's also an issue for fixed wireless access in the supply side. So what we see on the supply side is that this spectrum that they use in order to send the signal, the broadband signal, to the consumer is very valuable. And a residential consumer uses a lot of data per month. So in the US, they're using kind of 500 gigabits of data per month, whereas a mobile subscriber only uses 10 to 15 gigabits of data per month over their cellular subscription. And that means that by selling data over your spectrum, your valuable spectrum, to residential consumers, you're going to use your capacity up very quickly. And there is a limit to how many subscribers the US 5G fixed wireless access operators will want to actually have, because it will use up their data very quickly and their capacity. So we feel comfortable that despite 2022 and 2023 seeing lower subscriber growth for Charter, we actually think that once we get out to 2024 and onwards, that their subscriber growth will pick up. And they are hugely cash generative. We have seen that during this period where the share price, as you can see on this chart, is the white line. The share price obviously went up a lot, benefited from COVID, has come back a long way. But as you can see, the blue, red and green lines are the earnings forecasts for Charter. And despite this additional potential competition maybe taking some marginal consumers away from Charter, their earnings growth has been phenomenal and has not declined. Nobody is expecting their earnings to decline. And so we remain very confident. We have around $75 of free cash flow penciled in for Charter in our model by 2026. The current share price is around 350. So that's about a 20% free cash flow yield, which is not going to occur. So the only way that, if we're right with our estimates, that doesn't occur is for the share price to rise. And so we are pretty confident that Charter will do well. Just turning to Meta, which has been our other problem child of 2022. Meta's been hit really by three things in 2022. So as you can see on this slide, the cost of the metaverse, 12 billion or so in 2022. So maybe Zuckerberg's vanity project. Also, iOS changes that were made during 2021 are still impacting the company. So it's impacted the way that they can target customers, and also impacted the way that they measure the benefit of their advertising. And then thirdly, we've got competition from TikTok. So TikTok is obviously short form video. It's got 1.2 billion subscribers, and they are taking some share in terms of the amount of time that people spend on social media apps. And then lastly, there might be a small impact from economic slowdown on digital advertising, although that hasn't really come through yet, as we can see from Google's numbers. So we think that the big three impacts are of metaverse, the iOS changes from Apple, and the competition from short-form video are actually all overstated. We still think that Facebook and Instagram, and to a lesser degree WhatsApp, occupy a place in social media that cannot be replicated by the likes of TikTok. They're used to create communities and communicate between communities, and this is not what's done on TikTok. We talk to many experts in the field, and they tell us that the return on advertising for their customers, so these are digital ad agencies, they tell us that the return on advertising is still very high for Facebook adverts. And so we are very confident that actually Meta does remain very relevant. So we're relatively relaxed about the threat from TikTok over the long term. We think from the loss of signal from iOS that Facebook is in the best place to circumvent that issue from Apple. and actually over time it will create a barrier to entry for everybody else. And then the cost of metaverse, we do agree with most investors that this might be wasting money. It's binary as an outcome, so we don't know whether it'll be successful or not. We would actually ascribe very low probability to it being successful. But having said that, we think that if it's not successful, Mark Zuckerberg will stop the investment after some time. So we've put in $50 billion of cost overall into our models, and we've written that off as a one-off cost. And despite all of that, we think that the company looks extremely cheap at this juncture. So it's on 8.5 times core earnings and around 12% reported earnings. As you can see here, its earnings forecasts, which are the blue, red and green lines, have declined. So this is the impact that I spoke about from iOS, metaverse investment. So we are seeing the impact of those things on earnings, but we still think that this company will continue to grow over time and will remain extremely relevant and is very cheap at this juncture. So they've been the two big problem children for us during the year to date. This is the portfolio as we stand at the end of September. Very little change. We have quite a lot of cash at the end of September. Markets were declining. As you can see here, we have nearly 14% in cash. We are beginning to now get excited. Markets have declined a long way. We think there's opportunity for us to invest some of that cash in some very interesting positions and also to increase some of the holdings that we have that we've got a lot of confidence in. In terms of new activity that we've had year to date, we bought a position in a company called Biorad, which is a biologics business, produces lots of tools for the sector. They've got a very interesting product called Droplet Digital PCR, which we think is particularly interesting. Embecta came as a spin out, so we didn't actually make that acquisition. And in terms of sales, we've sold Cochlear, which reached our intrinsic value, so we sold the position. And CoStar, where we had a change in our thesis during our holding period, and we just were concerned over the US residential housing market, and so we sold that position. So with that, I'd like to invite you, Rob, back to grill me with some questions.
Thanks very much, Andy. There was a lot of information there, really insightful. Gave us a good understanding of what's been going on in the portfolio and what may be ahead. Talk about earnings, because we've been hearing a lot about the pressures on earnings for companies going forward, especially with the rise in interest rates and more wage pressure from coming through inflation. What does that do? Has that had an impact? Are you seeing any of that come through in reported earnings or maybe in any of the companies that you follow?
Yeah, it's a good question, Rob. We're not seeing anything at the moment in terms of the impact on earnings, and I think that what we will see is, because this is going to be an inflationary recession. So unlike the recessions we've had in the past, so in 2007 and 8 and 2001, which were very deflationary recessions, where there was a big impact on earnings because demand declined so much. This is an inflationary recession, and so the impacts will be different. And so if you've got a company that is relatively inflationary protected in its pricing, and it's not suffering too much from cost of goods increase, or it's got a high gross margin, then we actually think that they'll get through this with nominally reported earnings quite high. Now, of course, in real terms, those earnings are not increasing anywhere near as much because inflation is high. But in terms of nominal returns and what we're seeing, and we live in a nominal world, of course, we can still see these companies generating, 10, 12, 15% earnings growth, even though after inflation, that doesn't look so good. But nobody, you don't need to consider it after inflation because we're living in a nominal world. So actually, across our portfolio companies, we're pretty sanguine about earnings at the moment because most of our companies are heavily inflationary protected.
Okay, thank you. And we've seen the market fall off, or the MSCI World fall off about 25% since the beginning of the year, and potentially some sectors and companies have fallen further. Does that mean if the earnings are going to be relatively okay, does that mean then there's some really attractive opportunities there? I mean, you did touch on it, but can you give us an example?
No, so yeah, we think there's some really interesting opportunities out now. We've seen some of these companies have fallen 60, 70, 80%. There have been some massive declines. We think that the derating that was likely to occur because interest rates increased, so there was likely to be a derating because of that, and equities as a whole started quite expensive. But we largely think that derating is now done, and so if we can find companies where we're confident in the earnings and the growth profile going forwards, but the derating has happened, then of course we're getting excited about those sorts of companies. And there's a few companies, I can't obviously mention any names we're buying at the moment, But things we've been looking at recently are things like Salesforce, which could be very interesting. Share price has declined materially. ADI, which is analog devices. So they make analog semiconductors. So there's a lot of names out there where we feel relatively confident in the long-term prospects of these businesses, but their share prices have fallen materially.
So it's creating great opportunity for you and the fund as well.
Correct.
Well, once again, thank you very much for joining us. It's been great having you here in South Africa this week. So once again, thank you for all the information you provided.
No, thank you. And it's